Good afternoon and welcome to the fifth in our series of insurance pricing webinars. My name is Stephen Kennedy and I lead on insurance pricing at Pearson. My background is in more traditional retail pricing, but I was head of pricing for Hastings Direct between 2009 and 2017, establishing and building the retail pricing function there. Pearson is a pricing consultancy. We work across multiple industries, of which insurance makes up around 20 to 25% of the business, but we're also operating in several other market sectors. We like to blend extensive experience with technical knowledge to provide our clients with effective solutions. I'll be joined today by Hazel Davis, who supports on insurance, and she will be presenting some of the slides that we're going through today. This is an overview of some of the work that we do on a consulting basis, so we can get involved from technical price modeling, price optimization, predictive analytics, through to some of the more organizational change type aspects around pricing strategy, data, processes, governance, and looking at trading agility and ensuring systems and tools are correct and fit for purpose. If you'd like to know a little bit more, then you can download our insurance pricing brochure, which I'm going to make available to download now. So hopefully that is available in your chat screen at the moment. If you would like to look have a bit more information, then please feel free to click on that. As we go through the webinar, also please feel free to ask any questions using the chat function, and we'll endeavour to answer those at the end. Great, so let's commence. Okay, so today we're going to be looking at data and how to make best use of data. So data is crucial to pricing within any industry, and perhaps more so in insurance because there is so much more of it. Data has historically been used to better predict risk and manage your risk portfolio, and more recently to understand other drivers of customer value and sensitivity to price. There is a lot of data available, whether it be external, internal, regional, segment-based, or customer-specific, and the trick is trying to identify what is going to be the most effective data to use. So it's really key to understand the different types of data that are available and the relative benefits of each and how they fit in with your own business objectives.
Thanks, Stephen. So I'm Hazel Davis. I manage insurance projects here at Pearson. Prior to Pearson, I spent almost 8 years in pricing at AXA, and I've worked in technical pricing, market pricing, and pricing innovation, where we would test external data sources and, if predictive, help integrate them into the rest of pricing in the business, which is exactly what we're talking about today. Before Stephen talks more about the different sources of data you might be interested in using, I'm going to start off with how you might use that data and what that kind of process looks like. And I'm going to use the actuarial control cycle to illustrate this, which I suspect some of you will be familiar with. So starting in kind of the middle of the triangle, good data will help you define the problem better. If you really understand the problem and the underlying causes, you stand a much better chance of tackling it with the right solution. So first of all, you want to gather data to really understand the problem. So being able to get up-to-date data that really helps you break down your problem to understand the root cause will be good for your business. Once you've understood the problem, you can develop the solution, which often means building a model. And I guess everyone's heard garbage in, garbage out. You will only build a model that is predictive in the future if your past data is going to reflect future experience and your past data is as accurate and complete and consistent as possible. So you want good data to build a model, and whether that's building a new model to enhance your optimization, whether it's refreshing an old model because things have changed and it's time for a refresh, whether it's integrating a new data source into a current model to help kind of plug any gaps or stop you being selected against, kind of good data is going to be key. And once you've developed your solution and deployed your new prices, you want the data as quickly as you can to help you monitor the results and get that feedback that your model is behaving the way you expected. And actually building MI systems that can incorporate model outputs, model expectations with what actually happened can be simpler said than done. These data projects can be quite complicated, but the ability to get that monitoring feedback with reliable, consistent data will help you understand whether you've addressed the problem and you're done, or whether you need to iterate around the cycle again. Now, of course, this doesn't take place in isolation. Insurance is a fast changing market, and so understanding the external environment will also help you with your problem and your solution. And actually, the data you're interested in might be to help monitor the environment to let you know when you need to go through your model refreshing. And Stephen will talk a bit more about that in a minute. And of course, as an actuary, professionalism is very important to what we do. So from a data point of view, that's having good relationships with your compliance function, talking to them, making sure you understand the data you're using, that you're using appropriate factors in a way that you're allowed to, making sure you've covered the appetite of the business to use data from different sources, and that all the stakeholders understand what you're doing and it's all documented. So I've talked about kind of good data helping with this cycle, but what do we mean by good data? Well, I think the traditional aspects, you want it to be accurate. So you want the data to be correct and as complete as possible. You also want it to be consistent. So consistent over time. If you want the past to reflect the future, your data in the future will need to come in the same way that is consistent with how you've had it in the past, or at least you need to understand any changes and inconsistency to work around it. Also, you ideally want consistency with other data sources, because when a view of quote data from one bit of pricing conflicts with the view on quote data from another bit of the business, whether they're deduped in a different way, you want to understand what you're doing and get these data sources as consistent as possible. And then the timeliness of your data can be a real advantage. If you've got the data as up to date as possible and refreshed as quickly as possible, then you're going to be making decisions in as timely a way and as agile a way as possible, and that can give you an advantage. And we understand this and we can help with this. Okay, I think Stephen's going to talk about different sorts of data now. Thank you.
Thank you, Hazel. I'm going to start with market data. So understanding the market that you operate in is really fundamental to success. And there are various market data sources available to help you do this. A good start is reviewing competitor financial reports and tracking what they're saying in the trade press. So if there are any statements around footprint expansion or changes to strategy, that you're aware of those and you're cognizant of those when you're making pricing decisions. So it allows you a good background to be able to make those decisions within. And there is also the kind of consumer panel price tracking, which will enable you to track price movements in the market and to look at competitor strategies. So to be able to identify specific competitor strategies and to more broadly track the market and to help anticipate what's going to come next. And I think that that's key to it. In addition to that data, there are also indexes which are provided by the price comparison sites. So Confused.com and Money Supermarket provide quarterly updates, which show what's going in the market at an overall level and broken down into some of the key segments. So again, it's useful to have a variety of sources of market information to be able to help identify what's going on within your sector and what you think is going to happen next. And that, again, will help to inform some of your pricing decisions. There is also benchmarking data available from companies like eBenchmarkers, where you can see market share, how you're tracking over time and how the market's moving, and also survey data, which can be very useful in terms of looking at your competitors' market share, your competitors' retention, acquisition channels, and how these things are changing over time. So that is going to shape their pricing strategies and their business activities, which in turn is going to impact your own trading performance and your pricing decisions. At this stage, I'd just like to do a quick poll to get an idea from everybody about how do they feel market, what kind of understanding they have of the market and competitors' pricing strategies in particular. So I've gone live with that poll now. So if you want to just kind of respond now, I'll give you a few moments to respond to that, and we'll see what that looks like. So how well do you understand your competitors' pricing strategies? Okay, just a few moments more. Okay, so I think that there's some broad consensus here that we don't understand our competitors' pricing strategies well enough. Some understand better than others, but I think as a whole, 80% of us don't feel that we understand our competitors' pricing strategies. And it's really important that we do, and we try to understand those strategies better, because that's what's going to impact our own performance. And when we make pricing decisions and price changes, to be able to anticipate how competitors are likely to respond is really important. So moving on to another data source is aggregator data. So if you're operating in motor insurance or home insurance, then there's a vast array of data available from the comparison site. So they have access to huge data sets, processing millions of quotes every month, and they have packaged these up as data products for their insurer partners. And there are significant benefits for both acquisition and renewal pricing from these data sets. So you're able to build market pricing models, which will come up with a competitive market rate for a particular profile. So for an individual, you'll be able to see how competitive the market is for them, and that will inform your own pricing decision with them. At renewal as well, that comes in useful. So if somebody's likely to shop around, you have a good idea of the price that they're likely to see within the market. We can also build rank prediction models. Rank, a very strong indicator of sale on the comparison sites. So if you know or have a good idea of what rank you're likely to achieve with the price, then that will help in your calculations. So I think, why is this important? Because optimization relies on predicting customer behavior, and this behavior is driven by what's going on in the market and the context in which they're seeing your price presented. However, it is a fast-moving market, so we have to remember to regularly update any models that are built using this data, because things will be changing very quickly and you need to adapt with that. Customer data is another area where you need to have a clear view of what your customers want, so an understanding of customer requirements, how they're going to behave, how they're going to respond. It's crucial to make sure that you are delivering what they want and pricing it correctly. So information on demographics, affluence, life stage can all play a part in profiling prospective and existing customers and helping you to come up with the most effective pricing for them. So data enrichment has been a key word in the industry for quite a while now, and credit scoring really leading the way there. So credit scoring and credit information giving you the power to help identify the good risks within bad segments. So it really was a game changer when it came in terms of being able to identify better risks. So where everything else looks the same, the difference in credit score can be the difference between a good and a bad risk. And I think most of the larger insurers certainly have now incorporated this into their pricing process as a kind of the norm. I think since then, there's been a lot of scrambling around to try and identify what's the next big thing. So where's the next data set in which I can use to gain a competitive advantage? And there is a lot available out there, and a lot of it is paid for through third-party providers. An investment has gone into trying to identify where benefits can be achieved, and also making sure that that data can be provided in real time and used effectively within pricing. However, we should also think about other potential sources of third-party data enrichment, which may be out there free of charge. So there's a lot of postcode information available, and there's a lot of ONS statistics around regional crime stats, around earnings and working hours, and those types of factors that relate to affluence can be very useful in terms of trying to predict price elasticities and also to build into your risk modeling. So before spending a lot of money and investing a lot in paid for third-party data enrichment, try thinking about what's out there available, what's freely available, and how you may be able to use that as well. So as well as external data, there's internal data that a lot of insurers have access to, but maybe are not using to the extent that they could be. So we've observed a lot of kind of examination of the market and analyses to try and find what's the next big thing in terms of third-party data enrichment and resources being thrown at it, as well as funding. But I think there is a lot of value to be found in internal data. So there is a couple of parts to this. So there's the internal quote data that you may have, which you could use to look at customer behavior, so previous behavior, which can inform your predictive modeling. So where they previously purchased ancillaries or paid in a certain way, monthly or annually, rather than predicting it based on customer characteristics and other data you have available, you may be able to look at previous behavior if they've been a customer before or if they've run quotes. And the number of quotes run, the number of sites visited, the length of time between quote and inception date can all help to build a picture of an individual, shopping propensity and lifetime value, as well as those pieces of information that you can get from quote data or previous sales data. There's internal data in the form of different functions. So looking at a call center call tracking, for example, can help you to profile the types of people more likely to call in. And that's something that you can build in to your lifetime value models in terms of costs. So where you're looking at the variations, and optimization is all around looking at the differences. So the differences in margin. So the margin will be delivered by the revenue, but also the cost associated with an individual. If you can find those differentials, then there are advantages to doing that. So being able to identify the types of people that are calling in. There may be marketing data that's available around increased conversion rates during promotional or marketing communications. So when you're on TV, does that result in increased conversion? Do you don't need to be at the same rank on the comparison sites when you're doing that? So there are lots of different data sets from various functions within the business that you could be looking at and incorporating into your pricing activities. At this stage, I'd just like to take another poll, and this relates to what I've just been talking about in terms of internal data. So to what extent do you include internal data from other functions in your pricing? So always, sometimes, rarely, or never. I'll just give you a few moments to answer. Okay, so we're seeing quite a bit of consistency here. So 33% are always using internal data from other functions in pricing, and 44% sometimes. So it seems like there is a good connection between your other functions and pricing in terms of the data that's available to inform pricing decisions. I know that there can be issues if legacy systems are in place and there is little connectivity between them, but it's great to see that doesn't seem to be an issue for our attendees today. Okay, I'll pass over to Hazel now to talk about driving behavior.
Thanks, Stephen. So from a technical pricing point of view, obviously data on driving behavior is fundamental to trying to price the customers correctly. We really want to understand what is the likelihood that a customer will have a claim, and if they have a claim, how much is it likely to cost? But essentially, historically, we've been using proxies. So our best proxies might be how old are you, how long have you held your license for, what's your new claims history look like, and your claims history. And it's fine, those are predictive of how you've been in the past and how they're going to be in the future. But it does seem to me that telematics has a lot of potential to really improve the factors that influence the propensity to claim. And that it won't be proxies. If you can figure out what about your driving behavior makes you likely to have a claim, you can price more directly on the factors that matter. And whether that is going to be acceleration and braking patterns and how you take the corners, you were just pricing on the real thing and not trying to proxy it so much. So it's a really interesting space to be working in. I guess historically the appetite for telematics products has tended to be with the younger driver or new driver market, where customers obviously stand the most to gain in terms of saving money on their insurance, and therefore might be more willing to, share the data on their driving. They're not so worried about the privacy concerns. But it hasn't been such a mass market kind of product. People, don't necessarily want to share this data. But it does seem with lockdown and changing situations that people are kind of going, oh, well, I'm not driving the mileage that I'd expected to. My driving patterns have really changed. Actually, maybe I could benefit and save money on my insurance. And maybe I would do this to share my mileage with an insurer. That doesn't seem so bad. And I stand more to gain. So I think some of the reluctance to adopt it might be changing and overcoming, and we do see more partnerships with telematics providers in well-known brands and a bit more marketing on some of these products. So it will be an interesting space to watch and see how they're priced and see what the demand is for it. So telematics data has some big potential upsides. Young drivers get feedback on their driving and can improve their driving, so it's win-win for the driver and the insurer. But there are going to be challenges if this is going to take off and get more widely adopted, starting with ownership of the data, for example. What does the customer own? What does the insurer own? Can the customer just take their data to a different insurer? Because it kind of seems win-win. If the insurance company's got the best data on their customers, they know who to renew at the right prices, and it's like a really good way of selecting all the right risks and excluding the ones who are driving really dangerously. But how is that going to sit? How are we going to get standardization of metrics? But yeah, lots of opportunities for innovation in this space, and it'll be interesting to see how companies handle the data and how customers feel about sharing the data. And it's not just the driving insurance products that are going to benefit from big data. No presentation on data and insurance companies would be complete without a slide on a big data word cloud. So yeah, from a property insurance point of view, we've got Internet of Things, more innovations, products that can help you reduce your claims, alert you if you've got a claim straight away so that the leak can be fixed, or hopefully we can reduce the cost of the claims. From a health insurance point of view, there's more and more analysis on wearables. They're really taking off, and there's a lot of data out there. So the companies that are able to use the data in a way that is win-win for the customer. The customers will get better pricing, and hopefully, yeah, it's a good thing for the future. Of course, big data comes with challenges. Some of you see on the word clouds, the sheer volume of some of this data. There might be storage challenges and accessibility challenges, handling the volume of data, handling the velocity with which new data comes in, and you've got to keep refreshing things and keeping them up to date. The level of variety within the data, so how it comes in, is it reliable? Is it unstructured? How do you organize your systems and your analysis to handle kind of new formats or less structured data? But the analytics is evolving all the time. It's, again, a really interesting opportunity to try more complex analytics, use machine learning techniques to handle larger volumes of data and get some good models out there, solve the problems, develop the solutions, and hope they work in the market. So yeah, it's a really interesting space to be in at the moment. I will hand back to Stephen to wrap up, I think.
Thank you, Hazel. So it's clear that there are numerous data sets to choose from, whether it's market, customer, external, internal, small, big. So there are several and numerous data sets and sources that you can be looking at. Some require significant investment, while others are free of charge. So it's really key to be able to understand the costs and the benefits of each, so that you can make more informed decisions. Depending on your business, different data sets will be more or less appropriate. So you really need to understand what are the questions that you're trying to answer, and what data sets will be most relevant to the specific problems that you have within your business. And it's key to be clear about objectives from the start. So what is it that you want to achieve is your starting point. The data will allow you and enable you to achieve those objectives, but you really need to be clear about what your objectives are in the first place to be able to make the right choice about the data that you're using, and how you're going to approach it in terms of trying to identify whether the value is there or not. So that's really important to be able to build your business case, to build your use case. So it's about identifying what the opportunities are, what the challenges are, what are your objectives, and what are you trying to address. That will then enable you to look at the right data sets and make the right data decisions. Okay, so we're going to take some questions now. So the chat box is available there if anybody would like to ask any. I think there are a couple that have come through as we've been talking, so I'll just take a look at those. Okay, I have one here around what are the relative pros and cons of the different aggregator pricing indexes. I think the methodologies vary across comparison sites, the way that they're tracking market prices, and the profiles are slightly different. So if you look at the average premiums that are being tracked, then you can see that the mix is different. So I think the average premium for the confused index is around £800, which compares to Money Supermarket around £550. So there is a difference in mix, and the prices being tracked are not the kind of prices that have been price changes, but they can be driven by the mix to a certain extent. So I think that there are things to look out for, but if you are kind of aware of what the limitations are, then as I say, I think it's useful to be able to have as many sources as possible to be able to inform what you think is going to happen to the market and anticipate price movements that are coming up. I have another here, which is how frequently would you update market price models? So as I was saying earlier on, the market moves very quickly, so it's important to be able to adapt and move with the market. And I think I would update the market price models every time you get an update of data from the comparison sites. So I think if you can get a fortnightly feed, then I would be updating the market price model every 2 weeks. I think I would be looking at a similar update for conversion and demand models as well to update elasticity assumptions, because particularly in the comparison site world, the market moves very quickly, and those types of models can deteriorate as quickly. So if your competitors are changing prices very frequently, then you need to be able to adapt, and your elasticity assumptions need to be changed because the context in which you're operating has changed. Okay, so I think that's all we've got. And I think we've probably run out of time. Yeah, we've reached past now anyway. So thank you for attending. For those that have been to the other webinars in this series, thank you for attending those as well. So as always, if you'd like any more information, or if there's any business challenges that you're having at the moment that you think we may be able to support with, or just to have a chat about, then please feel free to contact me. So my details are there. You can email me at stephenkennedy@pearsonham.com, and I'll be happy to discuss and answer any questions that you may have. Great. Thank you very much. Have a good day. Bye.
Bye.